For investors looking to diversify their portfolios and increase their wealth, real estate investing has a plethora of alternatives. Some real estate tactics can be pursued by those with little financial investment or market experience, while others call for substantial resources and expertise. Real estate investing offers a range of possibilities, each with unique benefits and drawbacks, regardless of your degree of experience. 5 common real estate investing strategies will be covered in this extensive guide. Please hit subscribe button for more informative videos. Number 5. Flipping houses. One of the most well-known and often used real estate investing strategies is house flipping. In order to turn a profit, the procedure entails buying a distressed property below market value, fixing it up, and then selling it for more money. Pros: quick returns. Flipping houses can generate a fast return on investment, ROI, if done correctly, allowing investors to make a significant profit within a relatively short time frame. Control over property value. Investors have direct control over the property's value through renovations and improvements. This can lead to higher profits if the right upgrades are made, such as installing new kitchens, bathrooms, or flooring, or adding additional square footage. Repeatable process. House flipping is a scalable method. As long as an investor has access to capital and opportunities, flipping houses can be done repeatedly, growing their business over time. Cons: unforeseen costs. One of the biggest risks associated with house flipping is the potential for unexpected costs. Property renovations often uncover hidden issues, such as plumbing problems or structural damage, which can significantly increase expenses. Labor-intensive. Flipping houses can be a physically demanding task, often requiring long hours to oversee renovations, coordinate contractors, and handle logistics. Illiquidity. When you invest in flipping houses, your money may be tied up for a longer period of time, especially if the market slows or if renovations take longer than expected. This can create liquidity issues, limiting your ability to access funds for other investments. Number 4. Investing in REITs and real estate funds. Investing in real estate investment trusts, REITs, and real estate funds can expose you to real estate without the hassles of property management if you're not interested in directly owning property. Pros: accessibility. One of the primary advantages of investing in REITs is that they provide access to real estate without needing to own or operate the properties themselves. Investors can purchase shares of REITs, which can represent a wide range of real estate assets, such as residential, commercial, or industrial properties. Low entry barrier. REITs typically have low minimum investment requirements, making them accessible to investors who may not have large sums of money to invest in traditional real estate. Liquidity. Unlike physical real estate investments, REITs are publicly traded and can be bought and sold on stock exchanges, providing liquidity and the ability to exit an investment relatively quickly. Diversification. REITs typically invest in multiple properties across various sectors, allowing investors to diversify their portfolios and reduce risk. Cons: lack of control. Unlike flipping houses or direct ownership, investing in REITs does not allow investors to directly control the properties in which they are investing. This means they cannot influence property management decisions, tenant selection, or capital improvements. No tax benefits. REITs do not provide the same tax benefits that come with owning and operating real estate, such as deductions for mortgage interest, property depreciation, or expenses related to property management. Fees and expenses. REITs typically carry management fees, which can eat into the investor's profits. These fees vary depending. Number 3. The buy, rehab, rent, refinance, repeat (BRRR) method. The BRRR strategy is an increasingly popular approach to building a rental portfolio in real estate investing. It involves purchasing undervalued properties, renovating them to increase their value, renting them out, refinancing the property to extract cash, and then repeating the process with a new property. Passive income. Once a property is rented out, it can generate passive rental income for the investor, providing a steady cash flow over time. Building a rental portfolio. The BRRR method allows investors to quickly build a portfolio of rental properties, which can appreciate in value over time, increasing the investor's overall net worth. Equity growth. Through the rehabilitation process, investors can increase the equity in their properties. This allows for refinancing options that provide capital to purchase additional properties. Cons: time and labor intensive. The BRRR method requires a significant investment of both time and effort, particularly in the renovation phase. Investors must be prepared to manage repairs, coordinate contractors, and deal with potential delays. Market fluctuations. The real estate market is cyclical, and market downturns or fluctuations in interest rates can affect the value of properties and the profitability of refinancing. This makes the BRRR method particularly sensitive to macroeconomic conditions. Fees and taxes. Refinancing comes with costs, including closing fees, appraisal fees, and possible penalties if the investor does not hold the property long enough to avoid prepayment penalties. Investors should also factor in the potential tax liabilities on rental income. Number 2. Real estate crowdfunding. Real estate crowdfunding is a relatively new form of real estate investment that allows individual investors to pool their money together to finance real estate projects. This method allows you to invest in commercial real estate, multifamily homes, or new developments, with a lower barrier to entry than traditional real estate investments. Low minimum investment. Some real estate crowdfunding platforms allow you to invest with as little as $10, making it accessible to those with limited capital. Diversification. Crowdfunding platforms often allow investors to participate in a variety of real estate projects, which provides diversification across different asset types, locations, and development stages. Passive income. Like REITs, crowdfunding can provide regular dividends, allowing investors to earn passive income without having to manage properties themselves. Professionally vetted deals. Many crowdfunding platforms provide access to carefully vetted investment opportunities, helping mitigate risks associated with poor property management or high-risk developments. One of the biggest challenges with real estate crowdfunding is the lack of liquidity. Investments in crowdfunding projects may be tied up for several years, making it difficult to sell your shares or access your capital. Fees and expenses. Crowdfunding platforms often charge management fees or other associated costs, which can reduce your overall returns. Investors should carefully review the fee structure before committing to a platform. No direct control. Like REITs, crowdfunding investors don't have control over property management decisions, making it difficult to influence how the project is executed or managed. Number 1. Wholesaling real estate. Wholesaling is a strategy that involves finding distressed properties, negotiating a purchase price with the seller, and then selling the property, often before it closes, to another buyer for a profit. Wholesalers don't need to buy or hold properties themselves, making this a low-cost and relatively low-risk approach to real estate investing. Pros. Minimal upfront capital. Wholesaling typically requires little to no capital to get started. Investors often work with sellers and buyers using contracts and assignments, avoiding the need to purchase properties themselves. Fast returns. Wholesalers can earn profits quickly, often within a few weeks or months, by finding distressed properties and reselling them to buyers for a fee. No property management required. Since wholesalers are not responsible for managing or renovating properties, they don't deal with the complexities of property ownership. Cons. Small profit margins. Wholesaling typically involves smaller profit margins compared to other methods of real estate investing, especially if the market is competitive. Inconsistent income. Wholesaling may not offer consistent cash flow since it's dependent on the ability to find profitable deals. Investors may have dry spells where they're unable to find properties to flip or assign. No long-term equity growth. Unlike rental properties or flipping, wholesalers don't benefit from property appreciation or rental income, as they are only involved in the transaction process. Real estate investing offers a wide array of opportunities, each with its own unique set of benefits and challenges. From house flipping and REITs to the BRRR method, real estate crowdfunding, and wholesaling, there are options for every level of investor. The key to success in real estate is understanding your risk tolerance, investment goals, and available resources. While some methods offer quick returns, others, like rental properties and crowdfunding, provide long-term wealth-building potential. Thanks for watching. If you enjoyed this video and found it helpful, make sure to give it a thumbs up and hit that subscribe button so you don't miss out on our future uploads. Don't forget to turn on the notification bell to stay updated every time we post new content.